it's Neil again, and we're back. We're back for part 2 of the strategic analysis of operating income, and it's all about getting the attention of the top management in your organization. You got an initiative, you need to show how that initiative is related to the bottom line. Yes, we know that, and I did take you through in the previous section about the big picture. Ultimately, you may have total control over the operations, you have control over the employees, and so you're focusing the initiatives in these areas, but you need to make that connection with the financial measures, and then you get the attention of the CEO, the CFO, the CIO. Then you can convince them to make the big decisions that you need, because we know you need resources in the organization. You want more because you want to grow, and everyone wants to grow. You know that. So you want big decisions to be made. You want extra training. You want extra investment. That's what we covered in the previous section. In the next section, we're going to look at the strategic analysis of operating income. Now, depending on the company's strategy, whether it's cost leadership or product differentiation, and we have covered that in previous areas. Cost leadership is where your major bulk of your customers are focusing on price when they're buying your product. Product differentiation is where the bulk of your customers, the main decision in choosing your product or service is basically non-price factors. It might be quality, it may be ease of use, it may be short lead time, okay, and so it may be after sales service support. These are all differentiating factors, and their customers may come to you because of these non-cost reasons, and so we put that in the bucket of product differentiation. And most cases, on average, in most industries, if your product differentiation strategy enables you to have higher margins. With a cost leadership strategy, of course, you're under a lot of pressure to trim down your price and costs, because that is a major factor that is causing customers to buy your product or buy your service. Yes, so just a briefing on the difference between cost leadership, product differentiation. Now, if your company is following a cost leadership strategy, we want to really focus on growth, and we want to focus on productivity, and we not necessarily want to focus on price. It's not, yes, at the end of the day, we want to raise the price, but you can't do that, because customers are going to come along and say, well, the reason why I'm buying from you is because you have a lower price, you have a better value proposition, low price and value for money proposition. Whereas if you're following a product differentiation strategy, then it's growth that you're after, and it's price growth that you're after. You're actually looking to grow the price of your product over time, not diminish the price over time. You see that? And it's not necessarily productivity. Look, all of these three financial aspects of operating income are important. What we're doing here is saying, if you're following cost leadership strategy, then you're going to emphasize number 1 and number 3. If you're following differentiation strategy, you want to emphasize number 1 and number 2. Yes, you've got that. So this is how accounting can help manage strategy. Now, we want to get into an example here where we actually show how do we calculate the growth aspect, the price aspect, the productivity aspect. All right, so we have this organization. This is a chipset, and they're making chips, and we've got data for 2012, 2013. This was taken from the Horngren 15th edition textbook on cost accounting, if you're not sure. And we've got 2012, 2013. The prior period is 2012, the current period is 2013. Now, before we get into calculations, let's see here. Why do we have 2 dates? The reason is that enables us to calculate a growth. That enables us to calculate change. And change is very important when you're trying to convince people to give you money? Are you changing for the good, or are you changing for the worse? Okay, you're changing for the bad. All right, so this is the reason why we've got two sets of figures, and this is a very common approach to how we can use bottom line numbers to get the attention of top managers. Yes. So let's have a look at some of this data here. We've got units produced and sold of CX1, which is a chip, microchip, 1 million in 2012, 1.15 million in 2013. The selling price, $23 in 2012, $22 in 2013. What about direct materials? We got direct materials used, 3 million in 2012, 2.9 million 2013. What about direct material costs? This is not price, and this is a direct material cost, so it's a variable cost. $1.40 in 2012, $1.50 in 2013. You see the costs have gone up. What about manufacturing processing capacity? That really has gone down from 2012 to 2013. Yes, conversion costs, we have a total cost here of $16 million. That is all manufacturing costs other than direct material costs. So direct labor, indirect labor. What else? We've got direct overhead, indirect overhead. So we've basically got direct and indirect labor, and then we've got overhead including in these conversion costs. Labor and overhead are used to convert raw materials into the final product. You got that, I know. Now the conversion cost per unit of capacity is that we're going to divide these conversion costs by the manufacturing processing capacity. You got it. 3.75 million goes into 16 million to get $4.28, and the same for 2013 gives us $4.35, and that's per unit of capacity. So what other information do we have? We have the revenue. So basically this is the aggregate revenues where we've multiplied the 1 million units by $23 for 2012, 1.15 million units by $22 for 2013. So let's be very clear here. In 2012, the price was $23. In 2013 is $22. Interesting here, right? Obviously, that's not a good sign if you're following differentiation strategy, but you probably won't worry about that if you're following a cost leadership strategy. But we'll get into the actual calculations in a minute. Here we have the final revenues, and then we have the direct material costs, where we actually use so much of direct materials, and then we've got the cost per direct material. The conversion cost is the capacity here, and we multiply that by the units of conversion, and that basically is the total cost that we showed you earlier. There you have the 16 million and the 15 million here. Basically it's the same as what we've got here. Yes, so total cost, operating income, change in operating income. Now the change in operating income has good or bad. Actually, operating income has improved a lot. We're doing very, very well. Thank you very much for 2012 to 2013. So now we want to break down all of these numbers into a price recovery component, a growth component, and a cost component, because then we can be more focused on whether these numbers, what we've seen here, are supporting a cost leadership strategy or a differentiation strategy. Okay, here is the basic data for growth. So we're looking for the data for growth out of our total data set. These are the two PowerPoint slides that I showed you earlier. I just want to show you again to remind you what data we are working on. So we've got units produced and sold. Okay, that's an important part for growth component. So let's get into the first calculation, shall we? Okay, so notice we have the revenue effect, and that's very easy because in 2013 we sold 1.15 million units. In 2012 it was only 1 million unit. Yes, times $23 per unit. Remember, this is the prior period selling price. Very interesting that we're not using the current period selling price. So what we're really focusing on here is not the price effect. We're looking at the growth. Did we sell more or less than previous period? Okay, what about the cost effect for growth? Again, we're working with the prior period input price, not the current period. So it's always a prior period, and that's $1.40 per centimeter. But here we're interested in keeping productivity constant. Remember, we're focusing on the growth, not about productivity. We want to keep the price constant, and we want to keep the efficiency or productivity constant, and we want to see, did we grow, and what is the effect of that growth on our operating income? So keeping productivity constant, what should direct materials cost you in the second period? Yes, so the units of input required to produce the current output in the prior period, okay, minus the actual units of input used to produce prior period output. This is a tricky one here. All right, so to calculate this part here, what we do is multiply the current period divided by the prior period, and then we are multiplied by the units. And so this is a fraction that adjusts how much we should have used in the prior period. And we should have used 3,450,000 square centimeters. In the prior period, how much did we use? We actually used 3 million square centimeters. And so that difference multiplied by the $1.40 square centimeters in the prior period gives us that 630,000 unfavorable. And why is this unfavorable? It's unfavorable because the costs are greater. It looks like it's a positive number, 3.4 minus 3, that's a positive number, times $1.40, 630,000. But remember, this is not revenue, this is the cost effect of growth. So you know that any positive number for a cost effect is unfavorable, so that keep in mind. So let's summarize what we have for growth. We have, for the revenue effect of growth, we have a positive number because we have 1.15 million units minus 1 million times $23 per unit. But the cost effect of growth is 630,000 unfavorable. The costs have gone up as the number of units you sold have gone up. So there's the cost effect of growth. And so we want to have one more aspect of the growth, and that is for fixed costs. If capacity is large enough that in any one period you don't have to change the capacity, then there's going to be no variance here. Again, there's a tricky one. There's a tricky calculation here. That is the actual units capacity in the prior period that is needed to produce the current period output. And so in the prior period, the actual units of capacity needed would have been 3.75 million square centimeters, and actual units capacity in the prior period was 3.75 million square centimeters. So we have a zero variance. This doesn't change because there's no additional capacity. For example, you didn't need to hire new employees, supervisory salaries and things like that. The capacity was the same. So this is assuming adequate current capacity. What about if you don't have adequate current capacity? Then that would be the case where you've actually had to invest in more machines. You've had to hire additional people, and then that's going to be affected in this ratio because you're going to get a higher number here, and then that's going to create a higher number here, and because it is a cost, then that becomes an unfavorable signal to management. So keep that in mind. For most cases in the exercise we work through, we are assuming adequate capacity. But if there is inadequate capacity, then we're very much using the same formula. But when there's inadequate capacity, you know that the costs are going to be unfavorable, and it's going to have an unfavorable signal to top management. Let's have a look at the next slide, shall we? Okay, we want to go to the basic data for price. And what have we got here? We want to look at, first of all, we looked at the growth component. Now we're looking at the price component. This should be a little bit easier to follow because we know at the outset the selling price in 2012 was $23, and now it's 2013, it's $22. So is that good or bad? Of course it's not good. You want prices to go up, you don't want them to go down, you know that. So let's have a look at what are the critical ratios we need to calculate for the price recovery component. Now, first of all, we're looking for the revenue effect of price recovery, and basically this is how good is your negotiating power. If you're a really good salesman and you can negotiate better, you can get a better price, especially if you're selling. So this is the question. How good is your negotiating power? That's what this recovery ratio is telling you. The current selling period price was $22 per unit, and prior period selling price was $23. So now we have 1.15 million unfavorable. Wow, that's not a good sign for price recovery, is it? So let's have a look at the cost effect of price recovery. So what is the formula here? It's the current period input price minus the prior period input price. What happened? Well, we're focused on direct materials inputs, and we've got $1.50 per square centimeter, $1.40 per square centimeter. Again, this reflects how good your negotiating power is, especially the purchasing department when they're dealing with the supply chain. You know that. So if we take that difference, we know it's going to be favorable or unfavorable. Well, the current period you're paying $1.50, the prior period you're paying $1.40. So immediately you know it's going to be unfavorable. Your negotiation skills were not up to speed. They were not up to standard compared to the prior period. There may be other reasons, of course, but this is the signal that is given to top management. Now we've got the units of input required to produce the current period's output in the prior period. So that gives us 3.45 million square centimeters. Okay, let's just, this is a tricky one here. This 3.45 million square centimeters, we showed that in the growth recovery aspect before. That was the 3 million square centimeters. That was the 3 million square centimeters used in the prior period, and multiplied by 1.15 divided by 1, and then that gave us the 3.45 million square centimeters. So we are adjusting. We are getting the units of input required to produce the current period's output in the prior period. Okay. So we've got this 3.45 million square centimeters here. How did this come about? Well, let's break this down. The units of input required to produce the current period's output in the prior period. So in the prior period, how much materials did we use? We used 3 million square centimeters. 3 million. Can we write million? Oh, I need to write it here because we're off the screen. So we've got 3 million. Yes. All right. Let me get the O, and then we got the N. There we go. We've got 3 million here. Right. That's how much direct materials we needed in the prior period. Now, that's when we produce 1 million units. But now the units of input required to produce the current period's output, assuming we have the productivity remain the same. In the prior period, we used 3 million to produce 1 million. This period, we're using 3 million direct materials input to produce 1.15 million. So therefore, we need to multiply that 3 million by 1.15 divided by 1 million. And that's how we get the 3.45 million square centimeters. And look, at the end, this is positive, right? But it's negative. It's negative because it's a cost, all right? You don't want costs going up. That's why we've got this number here, 345,000. It's unfavorable because the costs went from $1.40 up to $1.50. Let's have a look at our next one. What about the cost effect of price recovery? And this is fixed costs with adequate capacity. Now, again, how good is your negotiation and pricing power? Now, the conversion costs are $4.35 per square centimeters, and in the prior period they were $4.28 per square centimeters, and we're multiplying by the actual units of capacity in the prior period. So you know that conversion costs, did they go up or did they go down? Well, on a prior period they were $4.28, the current period they were $4.35. That's not good, right? Costs have gone up. This reminds me so much as China, things are going up all the time in terms of labor costs and other costs. We have a price recovery component of fixed costs of $262,500, and that's unfavorable. That's unfavorable because this is a cost. Again, this can reflect your negotiating and pricing power. So this kind of summarizes our price recovery aspect component of financial reporting of operating income. Okay, so we've got one more ratio group to calculate, and this is basically the data for productivity. So far we looked at the growth component, we looked at the price component. Now we're looking at productivity, and we want to keep the price component constant, we want to keep the growth component constant, we want to know about the efficiency of conversion for the period. And look, it's possible that you can work with prior period prices or costs in the prior period, or you can work with the current period. The information is not going to change that much in giving the basic information about did we improve or decrease in our efficiency in converting materials into final units. That's the focus here. Whatever we do with the formulas, we need to work with either one period, either 2012 or 2013, and that's what we're going to do. So let's have a look at the formulas here. Now, we're working with 2013, and that is the units of input required to produce the current output in the prior period. We're going to take that off the actual units of input used to produce the current period output, and we're going to multiply that by the input price in the current period. So we have our input price of $1.50. That doesn't change. We're keeping that constant. But here's the big calculation. We have calculated this before. This is the units of input required to produce the current period's output, and that is 1.15 million units in the prior period. So what was that? We actually divided by 1 million units in the prior period, that was input, and then multiplied by 3 million units, which was the input of raw materials. Yes, we took this from the previous calculations. 3 million multiplied by 1.15 million units output in 2013 divided by 1 million units of output in 2012. And this is a base that's very important to capture here. It's like a base we want. All right. Now, here is the tricky part. what are the actual units of input used to produce the current period output. So this is just actual, there's no special calculations here, and we just need to go back to the data. So let's have a look at what we got. The data is there, there's no lying here. Look, it's 2.9 million square centimeters of silicon wafer. So that's where we got the data. And so that 2.9 million square centimeters of input minus what we should have used, do you think that is a good thing or a bad thing? Well, given that our growth has occurred, we've gone from 1 million units in 2012 to 1.15 million units in 2013, we should have needed more inputs in the second period. Based on 2012 efficiency, we should have used 3.45 million square centimeters. Okay, based on 2012 efficiency, but we only use 2.9 million square centimeters. We multiply that 1.5 per square centimeter, and then we get our 825,000 favorable. That's a great thing. Why? Because our costs are less. All right, notice this is a minus 825,000. The previous costs on the price recovery and growth recovery were positive. They were pluses, and that wasn't a good sign. But when it comes to productivity, we can see that this is a good sign. How good is your production process? Well, it looks like it's very good. So what other parts of productivity? Well, for fixed costs, assuming adequate capacity again, we are looking at two calculations. Again, we're working with the price per unit of capacity in the current period, and that's $4.35 per square centimeters. We want to multiply that by two numbers here. So this is our baseline number, and it's always related to the prior period. Actual units of capacity in the prior period to produce current period's output. So how did we get this? Well, it's in the original data, and let me flick back for you, and there we have 3.75 million centimeters. You know that it's direct, it's not a formula. And so that 3.75 million square centimeters was the capacity in 2012, but in 2013 it's only 3.5 million square centimeters. Again, for fixed costs, our productivity has gone up, all right, because we are using less in 2013 compared to what we should have used based on our productivity in 2012, which is this 3.75 million square centimeters, and that gives us a favorable variance of $1.087 million. Favorable. So how efficiency is productivity? Very favorable. Thank you very much. So here we have what we call it. This is a summary of all of these formulas that we've just calculated. We've got a total change in operating income of 2.79 million. That is favorable. There is the revenue and cost effects of the growth component. We have the revenue and cost effects of the price recovery component, and we have the cost effect of the productivity component. There are three parts. Now remember, if you're a cost leader, then you're really focused on the growth component and you're focusing on the productivity component. Yes, but if you're a differentiator, you want to focus on the growth component and you want to focus on the price recovery component. You're growing the margins. Now we know that chipset is following a kind of a cost leader. We've got that hints from an initial analysis of chipset strategy. So let's have a look at how chipset fares. So chipset is really focusing on the growth component and the productivity component. And you can see that overall chipset is doing very well on the growth component. Its revenues have gone up, and of course costs are always going to be unfavorable when there is a growth happening in the organization. We just want to know the total effect on operating income is net positive. Yes. What about the cost effect for chipset? It is favorable because chipset was able to make things more efficiently. It is able to produce 1.15 million units and use less materials and use less conversion costs. And so that's why chipset was able to get a huge favorable component with productivity. However, chipset was not able to do well on the price recovery. Remember, it went from $23 in 2012 down to $22 in 2012. And the costs went up. So not so good, but this isn't a focus of chipset strategy. Remember, price recovery is a focus of a differentiation strategy. Sometimes you cannot balance all of these three and push all of them at the same time. You need to emphasize two depending on which strategy that you are following. Sometimes you're focusing on productivity. It comes at the cost of price. For example, you want things to be delivered on time by raw material suppliers, and you may get a higher quality supplier to get things delivered on time so you can have a faster product life cycle. Then those raw material suppliers may charge you more to get things delivered on time. So there's always these trade-offs between getting more productivity and paying more to enable that productivity to occur. All right, so there we have our summary of chipset. In the next slide, I want to take you back to what it means for the two different strategies, cost leadership strategy and the product differentiation strategy. And so I've got a few markings here. We understand that chipset is actually following a cost leadership strategy. We know that, and it's actually focused on growth and productivity. Aren't we lucky because chipset has a favorable growth component and overall has favorable productivity? Aren't we lucky that, well, it works in very nicely for a cost leadership strategy? But chipset has an unfavorable price component, and so chipset focusing on cost leadership strategy is not so concerned about this as long as these two components are favorable. Now, if chipset was following a product differentiation component, then chipset would actually focus more on making sure that the price recovery is going to be favorable and also making sure that the growth component is favorable and may not focus so much on the productivity. See, so as you can see here, that depending on the general orientation or the focus of the strategy, senior management are going to look at different aspects of the operating income. Growth, price, and productivity are nearly impossible to focus on all at the same time. Sometimes you may have to give up one to get more of the other. Okay, let's get back to what it means for the balanced scorecard, because with the balanced scorecard we're not focusing on the financials. And why, after all this, in this exercise I've been focusing so much on the financials? Well, the financials get the attention of senior management. Now, which areas do you have control over? You have control over training employees, managing the culture. You have control over the operations, the replacement of the machines, replacement of people with robots, everything operational. You have just a little bit of control over the customer through your advertising and different markets that you choose to go into. You don't have control over the financials. So when you want to make change as a manager and you want to put initiatives, more training, you want to put in a new machine, you want to do more, strengthen your customer engagement, and you want resources for this from senior management, you want to get their attention to invest more in these areas, then you need to translate these initiatives into how are they going to affect the growth component, the price recovery component, or the productivity component of the financials, because the senior management are going to be looking for how does it affect the bottom line. And so then they can see you want to put in a new machine. This will enable us to improve our productivity, and this is how it will translate into improvements in productivity in the next year and the year after that, assuming that we are making the same amount of units. And so then senior management see, really, this is going to change our productivity. Oh, how does it translate into operating income? We can see how it translates into improvements in operating income because our costs are going down for the same amount of unit output. Okay, let's invest in this machine, or let's invest in more training of the employees, or let's invest in more engagement with the customer. See, you can see that cycle here. Number one, what is your initiative for improving the operations that you can control? You can only control the employees, the culture, or the IT environment. That's the learning and growth aspect of the balanced scorecard. You can only control the operations aspect of the balanced scorecard. This is where investment in initiatives go, but you need to translate that into the financials to get the attention of senior management, who can then make decisions to invest money into the learning and growth, invest money into improving operations, or invest money into improving customer engagement, which is an operational aspect, but still maybe invest money in brand name advertising, or actually invest money in brand development so you start to have some influence over the customer. Remember, initiatives are at the bottom two parts of the balanced scorecard, but getting the attention of senior management, we're actually focusing on that top part, the financial. There you have it. And that's why understanding the growth component, the price recovery component, the productivity components is important for your knowledge as an accountant or a manager in your organization. So hope you enjoyed this example, and I'll catch you in the next session. Bye for now.